Hi class, today we're going to be looking at chapter 17, problem 1B video. I'm going to share my screen with you. I've created an Excel spreadsheet for this particular problem. And what we're going to be looking at today is something that we call horizontal analysis. And horizontal analysis is a procedure that we use to help us to evaluate items on our financial statements to let us know what the condition of the company is. So in this particular company, we are going to be the Macklin Incorporated Company, and they have reported a significant increase in income. At the end of the year, John Mayer, the president, is presented with the following condensed comparative income statement amounts. First of all, what a comparative income statement is, it's just a regular income statement that's prepared for different time periods. In this case, we've got the time period for year one and a time period for year two. And so what you're going to be doing in horizontal analysis is analyzing each part of the income statement to determine whether there was a difference from the beginning of the period to the end of the period. So in this case, what we're looking at is $700,000 in year one. We're going to compare that to what happened in year two. So we simply subtract to find the difference in the amount. Cengage wants you to record this difference in amount here at $210,000. They also want you to show this as a percentage. To find the percentage, what we will do is we'll take the difference in the amount and divide it by the earlier year's figures that you are looking at for a particular problem. The earlier figures are what I refer to as the base year. So we're going to take 210,000 and divide it by 700,000, and that will give you a percentage difference of 30%. We're going to do that for each one of these items that are on the income statement. You'll first find the difference between year one and year two. The difference in cost of goods sold is $91,000. That difference is an increase in cost of goods sold from year one to year two. And that increase in amount of $91,000 can be converted to a percentage so that you would be able to compare the 2 years. So take 91,000, divide it by 350,000, and that will give you 26% as the difference. You're going to do this for each one of these amounts. And to save us some time today, I'm not going to do every single one of these with you. It's simply taking the difference between the beginning year and the ending year to determine whether there was an increase for the year or a decrease for the year. And it's obvious with this one is 350,000 in year one compared to 469,000 in year two. We've had an increase of 119,000. That increase can also be shown as a percentage by simply dividing 119,000 by the earlier year, the base year of 350,000. That will give us the horizontal percentage of 34% for our gross profit. And so once you've done that for each one of these line items, then you want to kind of step back and look at the percentages to see what happened from year one to year two. Notice your sales have increased by 30%. But also you should notice that your cost of goods sold has also increased. You know, if your revenue increases your sales, that's a good thing. But when your cost of goods sold, which is an expense, increases, that could be a bad thing. So we need to look at the differences and determine what the difference is as a percentage, and then analyze what's going on with the particular company. So although we've had increase in sales of 30%, we also had an increase in cost of goods sold by 26%. And so all you're doing is analyzing the amounts. In the end, we look at our net income, and you can see it's increased by 53%. So you probably want to decide why that net income increased by 53%. And you can say, well, we've increased our sales, but we've also had some increases in expenses. So to help us in the future to increase our net income even more, we might want to take a look at some things that would help us to decrease our expenses that have gone up. As you can see, your selling expenses increased by 21%. Perhaps you did a marketing campaign to sell your products. Well, it worked. It increased the sales by 30%, but you still had an increase in those expenses. If you could somehow whittle down these increases in expenses, it'll give you more opportunity to generate a higher net income percentage. And so when we talk about horizontal analysis, all we're doing is we're comparing 1 year in the company's life to another year for that very same company. And we're determining whether there was an increase or a decrease. And by this information, management can make better decisions about how to operate the company. The whole idea about analyzing your financial statements is to help management to understand what they can do better. So in the second part of this problem, they gave you a question that says, review the relationship of the accounts and the effect of the differences show about the business. And so they just put it into a formula for you, and I'll just read this to you. The net income has increased from 2001 to 2002. You can see that that increase was 80,400. The net sales have increased by 30%. However, the cost of goods sold also increased, and the selling expenses increased, and the administrative expenses increased. So since the expenses have increased, the net income is actually increasing at a slower rate, but it causes a strong earnings growth. So net income has increased from 2001 to 2002. Net sales have increased. However, the cost of goods sold, the selling and administrative expenses have also increased. The expenses, they have increased, but they have increased at a slower rate, which actually caused the net income to grow. And so that's all I want to talk to you about today. Bye-bye.